monetary policy is tight and having a big impact. I think you're gonna end up crashing this economy because they don't understand the leads and lags. They certainly understand there's some lag to their policy and when things respond, but I don't think they understand how long and how easy it is to get past the point of no return in terms of policy.
Hi, I'm Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for the week of September 13th through September 20th, 2022. This week we're highlighting some of the most exceptional 10-ounce silver bars in existence. Made by the Valcambi Mint in Switzerland, these 3/9 fine bars are cast, not pressed, have a unique graduated rectangle shape, and carry an individual serial number. Best of all, they're available at only $3.59 over spot. We also feature this week what are likely to be some of the last coins to bear the portrait of Queen Elizabeth II, the 2022 Silver Britannia and Silver Maple. The Silver Britannia is made by the Royal Mint in London, is 3/9 fine and available for $5.25 over spot, while supplies last. The Silver Maple is made by the Royal Canadian Mint, is 4/9 fine and available for $6 over spot, again, while supplies last. All our specials this week are IRA eligible. And if you have an IRA that's holding stocks, bonds, and $1 subject to runaway inflation, well, you'd rather have it holding precious metals? Call us, and we'll be happy to help you in that process. Call us today, tonight, or even after hours and weekends at 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is David Hunter, the contrarian macro strategist with 49 years on Wall Street. David, thank you so much for joining us today.
Yeah, hi Elijah, it's great to be back.
Well, it's great to have you. And I did want to discuss inflation to begin with, because we just got that number, 8.3% for August. Now, that's the official number. Some people think it's higher than that. But your take on this, because I know that you actually think inflation has peaked and will be going down from here. So your perspective on that?
Yes, I think inflation has peaked. It obviously came in higher than expected for the month of August. And people responded to that pretty negatively. Obviously, we had a big hit to the market. What I've talked about for a long time is the leads and lags to these policies. And people act like you conduct policy and then look the next month to see the change, or the next couple months. The inflation is a lagging indicator. It comes in many, many months later. What the Fed's trying to do is dampen demand and bring inflation down. I think they are accomplishing that when you look at commodity prices, when you look at some of the activity in the economy, like housing. It's very clear that their policies are taking a toll on the economy. That's exactly what they are aiming to do, is try to bring inflation down through dampening demand. I think what you're going to find, though, is that they don't really understand the long lead time. And by the time they get the response they're looking for, you're well past the time when they should have eased. So, they're making a mistake here, I think, in terms of wanting to see the whites of the eyes of the coming down of inflation before they move back the other way. That's way too late. Futures, things like that, give you some leads on what's going on. Housing certainly is something that tells you that monetary policy is tight and having a big impact. I think you're gonna end up crashing this economy because they don't understand the leads and lags. They certainly understand there's some lag to their policy and when things respond, but I don't think they understand how long and how easy it is to get past the point of no return in terms of policy. We see it often. The Fed has been notorious for creating hard landings because they don't understand leads and lags. And I think this time the dangers are even greater than normal because the leverage is even greater than normal. We've got $300 trillion in debt across the globe, and all the central banks are worrying about inflation. They better understand that if they misstep, that step is a huge one this time because of that leverage, because of that debt. And that doesn't even take into account derivatives, which are also a huge form of leverage on markets. So I think we've got to let the dust settle here on the short-term reaction in the markets, but ultimately, I remain a believer that things are going to go the other way here. We're not in a situation where inflation is going to keep roaring away.
No, I know a lot of people out there are saying that the Fed is not doing enough actually to control inflation and can't do enough to control inflation. If you look back at what happened with Paul Volcker, raising rates to about 19% or so to quell inflation then back in the 80s. But what you're saying, it sounds like, is actually the Fed is going to overshoot and inflation, they're being too aggressive right now. So obviously you do have a contrarian view. Can you explain a little bit more on why you think the Fed is being too aggressive right now and where inflation is going to head in the near future?
Yeah, that is one of the dangers, is I think Powell is using Volcker as a model, and a lot of people on Wall Street are looking at that period because that was the last period where we had inflation at such elevated levels, much higher than it is today, but still we haven't been anywhere close to that until now. So people are looking at the period in the early 1980s and thinking we have to follow that script. If we followed that script, I understand why people think rates are just beginning to go up and why they could go up to 5, 6, 7, 8%. That's not the case. Policy is tight. You can't measure it by nominal rates and wanting them to get up near where nominal inflation is or where inflation is. What we've seen is a very rapid rise in the rate of change of rates. Rates went from virtually zero to where we're now, pushing over 3%, and where the 2 years, approaching 4% from almost zero. So those are huge changes, and that's all happened this year. That's unprecedented. That's a rapid rate of change on rates, and I think that has much more. That's a more predictive tool than the actual nominal rate in terms of how tight you are. And just look at housing. That's a good example. Housing mortgages were 2.5%. They're now moving towards 6.5%. Think about that. People could afford at 2.5% a whole different mortgage payment than they can afford at 6.5%. It's going to have a dramatic impact on housing activity and housing prices, and that's a backbone of this economy. Now, again, it'll move gradually. There's things they can do. The home builders can, absorb some of the costs, mortgage costs, et cetera. So there's ways that you can postpone the pain, but that pain's going to hit next year and hit in a big way. And it's already hitting. I mean, the activity is slowing down, and we are seeing prices come in. I think, again, the surprise here is once we start rolling over, just how fast and hard we roll over. So, I think people make the mistake of thinking you have to get nominal rates up near inflation. That's not even close to true.
Now, as we see inflation cooling then, in your view, and rates falling as well in this environment, how will the stock market be impacted? Because it seems like we've been on a wild ride since the beginning of the year. We've been down, up, back down again. Where are we headed from here?
Sure. By the way, I've been for quite a while been talking about a global deflationary bust. And this policy we're seeing now is exactly why we'll be there next year. So I think deflation is the risk, not inflation. In terms of the stock market, I'm out there with a view that's very contrary to most people. People look at the economy not doing nearly as well as it was. It's not operating on all cylinders now. Earnings are starting to come under a little bit of pressure. Fed tightening is, the whole saying out there is don't fight the Fed. So there's lots of reasons to be bearish. And that's why we had a the S&P fall 24% from its highs earlier this year, why the NASDAQ fell 30%, or almost 30%. So we've certainly had a bear market this year. And a lot of people want to say this is not nearly done. And you hear calls of 3,000 on the S&P or lower, because people see a recession in the cards. They see a Fed that's got a long ways to go in terms of its tightening. I get all of that. And I think next year you are going to have a rough ride in the market. But I think in the short run, we've kind of hit a level, and we hit it in June, where I think we may have had the bottom of this particular correction. And we may go surprisingly sharply higher in the other direction for a period of time before we come back to the reality of next year being a deflationary bust. So I'm calling for 6,000 on the S&P still. It's hard for people to wrap their head around that when they're bearish. But sentiment is as negative as it was in 2008-9 or in 2002-3 or back in 1982. At bottoms in the market, we are looking at very negative sentiment. People know that what the Fed's doing is going to hurt the economy. They know that all of that inflation is not a good thing, and they've acted on it. What I think is going to be the surprise is if bond rates start coming down because of this weakness in the economy. I think that's the pivot. Everybody talks about a Fed pivot. I keep saying I'm not trying to predict when the Fed's going to pivot, because that's a human being's decision. I can't know whether they'll do it after September or later. But what I can predict is the aggregate bond market is, from what I see, is getting ready for a move down in rates. So yes, it pushed up this week with the Fed, with the inflation number, and that's got people spooked because rates have pushed up higher than even I expected. The 10 years at almost back to the highs of earlier this year. It's at 345, 346. I actually think we'll see the 10-year down at 2% by the end of the year. If you get a move from almost 3.5 down to 2%, that's going to move the stock market up, not down. And that's my expectation. I know it's way outside most people's expectations, but hey, I'm a contrarian, so that's what you get.
And I think it's important to also understand the timing of this as you're looking at a very long-term trend. It's not like something that's just happening. You're not looking at a trend that just started a couple of years ago. You're looking at something that's been going on for 40 years, this secular bull market in stocks. And this is kind of the tail end of it. What happens is this, I guess, melt up, as you've talked about before. Can you expand on that? How it's really not like a short-term thing. This is the tail end of something that has been going on for 40 years.
Yeah, we're at, as you say, we're at in the 40th year of a secular bull market. Started in August of 1982. That was the beginning of the trend down in inflation and the trend down in interest rates. Back in 1982, interest rates on the 10-year were 15%, and the long bond were 15%, and inflation was over 20%. We spent the last 40 years ratcheting that down, such that in 2020, the 10-year got down to 0.4, and the inflation rate got down pretty much to zero. What we're doing here is just putting on the final touches to a secular bull top. Now, I get pushed back when people say the melt up happened in 2020, 2021. And I go, absolutely, we had a melt up. The market doubled, more than doubled in 21 months' time. That's a melt up. But that doesn't mean you can't have another even steeper leg into a top. And because of what's happened this year, and because of the way sentiment is positioned, we have one last leg up. I didn't expect it back then. That's why I thought we would have topped, that the top we saw at the end of 2021 was going to be the top of the secular bull market. But things change. And what we've done here is kind of opened up the opportunity for one last run. It will be parabolic. It will happen relatively fast. I don't know whether fast is 3 months or 6 months or 7 months, but it's going to be a lot of ground covered in a very short time. So with the S&P at 3,900, and if it goes to 6,000 in 6 months' time, that's a steep run. And it's, again, I'm not calling for it as the beginning of some big, long bull market. It's the tail end of a bull market. And then what comes after that, I think, is an 80% bear market. So this is the last hurrah. It's not, people think I'm a raving bull. I'm not. I'm just calling the market as I see it. I'm not telling people they should chase it. I'm not telling people it's a good market. I'm just telling you what I think the market's going to do.
And you're seeing that because of the very negative sentiment right now, right? Because, I mean, I know you've mentioned that the sentiment currently is about the same of where we were at the bottom in 2008. So it's like, wait a second, we've only gone down like 20% in the stock market, but the sentiment is as bad as the bottoms in the past. So that's telling you that we're headed higher from here?
Yeah, because sentiment is the reason a contrarian work or contrarian analysis works, and why sentiment's so important is because people act on that sentiment. So if people for most of this year have gotten more and more bearish, they've acted on that bearishness. They've positioned themselves for expecting lower. And then all of a sudden, if the market moves the other way, they're forced to cover. They're forced, some of it's short covering, some of it is just repositioning. But for all those people, whether it be hedge funds or institutional investors or retail investors, if they've expected a much lower market, and then it turns, the short covering, certainly the short interest has to cover because they'll lose their shirts if they just stay short. So you'll see that, and then as that kicks in, it pushes momentum even higher, and you get FOMO kicks in, fear of missing out. So because so many people are positioned bearishly, if we get what I see as a setup that goes the other way, it's pretty predictable that what you're going to get is piling in. And so right now, everybody's acting on their intellectual bearishness. But what will drive them back in is the tape, what I call the tape. If the momentum moves to the upside, it's pretty predictable. So will investors.
And when it comes to the metals, I know that we've seen quite a downturn this year. As we're recording this on Thursday, we're seeing gold actually below $1,700. Silver's around $19. Your perspective, your take on where those are headed in the near future, then, as we see this melt up in the stock market, rates decreasing, and inflation cooling off as well.
Yeah, it's interesting because metals have certainly been an underperformer for a long time. They had a great run between March 2020 and August of 2020, but they've been very disappointing ever since. And they have this year, you have to look pretty hard to get it, but on a relative basis, the metals and miners have started to behave themselves a little better. And so, and part of that's because equities have done so poorly. So on a relative basis, the metals have held up a little better. Gold went to new lows today, and that's spooking people. But I think it's just a final kind of shakeout, trying to shake out any weak hands that are left. Silver's acted better of late, and it's pulled back here this week. But frankly, both gold and silver, as well as the miners, are all looking poised for what I think is finally their day in the sun. I think you're going to see gold move to 3,000 over the course of the next 6 to 9 months, and silver move to probably 50, which has been my target over that same period. So that's a huge run from here. And it come as a surprise to a lot of people who've kind of thrown in the towel on it. And particularly today, people are talking about gold going to 1,400, et cetera. I think gold's ready to run, and I definitely think silver's positioned. So, and the miners, if we get the move in the metals, the miners will follow along. And the miners are starting to show relative upside performance here. They've pulled back this week, but they're still, higher highs and higher lows from last week. So I think we're pretty close.
And then I guess how people should be playing this right now. I know you don't give financial advice, but it seems like there's a lot of movements going forward. I guess sitting tight, I think, is maybe a good thing, and maybe not being distracted by the daily movements in the markets, because it sounds like we're headed for a wild ride, and people need to just think rationally instead of being caught up in emotion. But your take on that?
When I get on Twitter a lot, it drives me nuts. I can't, you're right. I can't give advice. I can talk philosophically, I guess. But what drives me nuts is when you get a number like we had Tuesday in CPI, you have a very bad day. It was way, inflation was way above expectations for that particular print. And you had a very bad day, and markets, went south. The next day, people act like, okay, they can read what happened on Tuesday and then the follow on Wednesday, and they can come up with these, long-term projections of why. And they, in other words, there's a lot of impatience out there where if something doesn't happen 2 days later, they give up and they say, okay, see, yes, we had a weakness Tuesday, but you're not getting any more strength today. And, it's kind of treading water. And I'll step back and I'll go, my calls aren't based on this week or next week or the week after that. I'm talking about a move to 6,000 on the S&P that happens over the next 3 to 6 or 8 months. I'm talking about a move in gold that's next 6 to 9 months. Don't try to pass judgment on those calls or the markets movement in that direction over a couple days. It's meaningless. The market loves to play on people's emotions and people's impatience and get them to bail out at the exact wrong time. So people need to be very careful and understand cycles. And I'm talking about an economic cycle. Inflation, what the Fed's done this year will show up in terms of the reaction to that next year. What's going on in the economy will play out over many, many, many months. And these people are trying to change their forecasts and their expectations on a daily basis based on the tape. What happened today or what happens tomorrow? I don't understand it, because that's not how the economy works. It's not how markets work. But everybody's kind of caught in a day trading mentality. And as a result, I think they do have far too much impatience. And I get it. When the market's going against you, an hour seems like a long time. So I get the emotion, but that's the worst way to invest, is to let your emotions dictate what you see and what you do.
All right. Well, David, before we let you go, are there any last thoughts you'd like to leave with our viewers, and where can they find you online?
Yeah, I guess probably the only thing I will say is be well aware that we've had a very long cycle, and we had a lot of money poured in the 2020, 2021 period, and it did kind of propel things to unrealistic levels. But just be well aware that, all good things come to an end. And I think next year is going to be a very tough year economically. So, be careful out there. Don't get reckless. And, investing is not gambling. So don't allow your investments to become, just like going to the casino. As to where I am, you can find me on Twitter most days. Like I said, I'm battling COVID right now, so I'm not too active this week. But you can find me at Dave H. Contrarian on Twitter. When hopefully I'll be back on my feet next week. and you'll see more of me there. And I also have a quarterly letter that I put out, and I tell people it's comes with a cost. It's by subscription, and the way to find out about that is to direct message me on Twitter, and I can provide you details.
All right. Well, David, thank you so much for joining us today, taking the time, and definitely get better soon, and God bless.
Okay. Thanks, Elijah. You take care.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.